Warren Buffett's a master at turning market slumps into gold mines. He swoops in when everyone's panicking and buys stocks at bargain basement prices, then rakes in the cash when things turn around. With whispers of another buying opportunity brewing in 2024, fueled by all this uncertainty, Buffett's sending a clear signal. A golden chance to get rich is coming, and if you miss it, you could be seriously left behind. In this video, we'll crack the code on why this might happen, what it means for you, and most importantly, how you can get ready to seize this incredible opportunity to build wealth and leave everyone else in the dust. First, let's unpack what happened last year. Remember how 2023 felt like a gut punch? Between March 2022 and January 2024, the Federal Reserve hiked interest rates 11 times. This made borrowing crazy expensive, squeezing everyone's wallets. But even though things are shaky right now, what if I told you 2024 could actually get bumpier? The economy's facing a triple threat: high inflation, potentially even higher interest rates, and a ballooning national debt. These issues hit everything from real estate to how businesses borrow money, and the effects will be felt far and wide. For starters, the government will be stuck paying a bigger chunk of change on its debt, which might mean higher taxes for us down the line. Remember all those expert reports predicting millions of job losses in 2024? Well, guess what? It's already happening. American companies laid off over 84,000 people in February, the worst February for jobs since 2009. Sounds pretty grim, right? Here's the twist. Warren Buffett would tell you a different story. Even in the face of these dark financial clouds, there's always a silver lining, an opportunity waiting to be snatched. But to grab it, you need to understand one key concept: PSDO. Never heard of it? Don't worry. It's just an investor's fancy way of saying panic sale discount opportunity. Here's the gist. Panic leads to people dumping their stocks without thinking, creating a goldmine of discounts for savvy investors who can then turn those discounts into massive profits. Remember when Warren Buffett said this about the American economy back in 2009? It continues to improve. I just don't see it going down. A lot of people scoffed at his boldness then, but guess what? Time, as always, proved him right. America has a history of taking some serious tumbles, but like clockwork, the economy bounces back, and fast. The people who benefit most from this resilience are those who think like Buffett, those who understand PSDO. They're the ones who win in the long run, even when things look bleak. Let's face it, the rich are crushing it right now. But before we get into the weeds, let's use a real-life example to explain this whole PSDO thing. Remember back in 2020 when the pandemic hit China and then the whole world? The markets went haywire, with everything dropping like a rock. People were freaking out about their investments, some even predicting a total meltdown. But guess what? We all survived, right? Now, for those of you who were around for the 2008-2012 housing crash, you know things got ugly. Prices hit rock bottom in late 2008, with the median existing home price in the US plummeting to a record 12.4% compared to the year before. It was the biggest drop ever. Imagine the panic back then. People were desperate to sell their houses, fearing the market would never recover. But here's where things get interesting. Enter you, a regular person who followed Warren Buffett's wisdom and understood PSDO. While everyone else saw chaos, you saw opportunity. Even with friends and experts advising against it, you went against the grain and bought a discounted house, believing the market would eventually bounce back. And guess what? You were absolutely right. As the years passed and the dust settled from the crisis, your cheap house skyrocketed in value. Your gamble, fueled by PSDO, paid off big time. This financial story about you perfectly illustrates Warren Buffett's love for those moments when the market crashes and stocks go on sale. Just like Warren Buffett himself says, he loves a good fire sale when it comes to stocks. He's been buying them since he was a kid, so a market dip is like a discount on his favorite candy. The best rewards often come from doing the opposite of everyone else, trusting your gut and taking a calculated risk. That's probably why Buffett also said to be wary of investments that get everyone excited. The real moneymakers are often the ones that fly under the radar. Think about millennials and Gen Xers for a second. They've lived through 3 once-in-a-lifetime buying opportunities. Remember the dot-com bubble back at the turn of the millennium? Companies with .com in their name were the hot ticket, raking in millions from Wall Street. Nobody stopped to question if it could last. The market was booming, everyone was making money, and it felt like a party. But, of course, bubbles burst eventually, and this one wasn't any different. People panicked, convinced the internet was a fad, but hindsight is 2020, right? Now we see how emotions like fear and excitement can cloud the judgment and lead to bad investment decisions. That's why Buffett always says the biggest investing mistake is listening to the crowd. To win, you need a clear head and the ability to filter out the noise. So the key takeaway here is that market panics create opportunities, but to seize them, you need to understand PSDO and be prepared for the long haul. Let's talk about recessions for a second. The US seems to have one almost every decade, like clockwork. The longest stretch without one actually came after the 2008 crash, but then the pandemic hit and everything shut down. It was rough. Some say the worst since the Great Depression. But here's the thing, even in tough times, there's opportunity. When things get bad, there's also the potential for big growth. But remember, this only applies if you understand PSDO and are ready to play the long game. Think about it this way. If you're financially prepared during good times with some money saved up, you'll be in a great position to snag those golden opportunities when the storm hits. Now, I can't tell you exactly when things will take a dip in 2024. Nobody can predict the future. But there are some warning signs we can't ignore. The cost of living is already crazy high for most people, and higher interest rates make it even worse. We're also drowning in debt. Credit card debt, corporate debt, real estate debt, it's all at record levels. And to make things even trickier, a lot of office space is sitting empty right now. Imagine landlords having to renegotiate their massive loans at even higher interest rates. Their costs will skyrocket while their income dries up. The Federal Reserve is also hinting at something called controlled unemployment. Basically, they want to see a little more unemployment to cool down inflation and slow down the economy. Here's the logic. If a few million people lose their jobs, they and their families will likely cut back on spending. Meanwhile, those who keep their jobs probably won't see much of a raise. Why? Because companies won't feel pressure to raise wages if they don't think they need to compete for workers. It's all a plan to slow down price increases, but even though we don't know exactly when it'll happen, the signs are there. Economic slowdowns are a natural part of the system, and we need to be prepared for them. That's the key takeaway here. So the big question is, how do we prepare for this? It might seem crazy, but Warren Buffett has shown us that investing can be simple. Here's a 3-step plan to follow when a crash hits. Step 1. Know what you own and why. Buffett says selling because everyone else is panicking is a bad move. Understanding your investments is key during rough times. When you really know the businesses you're invested in, you can assess the risks and spread your money around to minimize losses. This way, you can focus on the long game and not get caught up in daily market swings. Step 2. Diversification is your friend. Market downturns are risky, especially in the stock market. That's why diversification is the golden rule for protecting your money during a crash. No single investment is invincible. Some might lose value during a crash while others might hold steady or even grow. By spreading your money across different asset classes and industries, you avoid putting all your eggs in one basket. If one investment does poorly, it won't wreck your entire portfolio. Step 3. Embrace the sale. Remember what Buffett says, falling stock prices are a good thing for investors. Crashes are actually how people get rich. If you want to win during a downturn, you have to be ready to buy the dip, basically buying stocks at a discount. When the market crashes, it's like a fire sale for investors. You should be ready to invest in things that are on sale. Okay, let's talk about buying the dip. Remember the fictional story about you from our real estate example? Yes, that. So in that supposed example, you were prepared when the market crashed because you had your finances in order. Here's what you need to be ready in reality. Emergency fund. This is the safety net for unexpected expenses so you don't have to touch your investments. Retirement savings. Make sure you're on track for your golden years. Cash on hand. Cover your everyday bills comfortably. Investment war chest. Have some extra cash set aside specifically for opportunities like market crashes. Wish list. Keep a list of stocks you've researched and would love to own at a discount. You probably won't nail the absolute bottom of the market, but that's okay. Value investing is about finding stocks that are on sale and have strong potential in the long run, not about pinpoint timing. To avoid worrying about buying at the exact low point, consider dollar cost averaging. This means investing a set amount of money at regular intervals, like every month. This way, you'll buy more shares when the price is low and fewer shares when it's high, averaging out your cost per share. Finally, here's some golden advice from Warren Buffett himself. If you wouldn't hold a stock for 10 years, don't even think about owning it for 10 minutes. It's normal to feel nervous when the market dips and see your portfolio shrink. But if you're in it for the long haul, the best thing to do is stay calm and avoid hitting the sell button. Why lock in your losses by selling when a downturn is temporary? Look at what happened in February 2020 when the COVID-19 crash hit. An S&P 500 ETF, a basket of stocks that tracks the market, could have plunged by 30%. If you sold then, you would have lost that money for good. But if you held on, you could have recouped those losses by August of that same year. Keeping a long-term perspective during market chaos is a strategy that will always serve you well.